Well, I guess it's a tale of two storylines this morning. On the one hand, we got some economic data in the United States that suggested that there was actually faster than estimated growth in the U.S. economy based on the most recently available GDP numbers. However, everybody's heard the tariff worries, and once again, as we've been reporting all morning, now the auto sector is plainly in sight on that front. Maybe that's winning, but what wins out in the long term? Tyler Elgard is a portfolio manager at Gradient Investments, joins us now. Tyler, great to have you back with us. How are you making sense of the headlines these days?
Well, it's quite a challenge because it seems like every day there's a new tariff announcement or something is being excluded from the tariffs that were announced. So it's been quite a challenge to keep up. But from our standpoint, positioning our portfolios that, I wouldn't call them tariff proof by any stretch, but I think at the end of the day, the companies that we're looking at are on solid fundamental ground regardless of the tariffs and still have the demand from consumers or businesses that I think will continue to drive the stocks higher, even with the tariff headlines. I
appreciate that. And I want to go through a couple of ideas you brought to the table to sort of explain how you're thinking about the markets. First, though, just a broader question about the market itself. So coming into this year, it's no secret, we saw two very strong years for the S&P 500. So there was already kind of this narrative about whether stocks had gone too far, too fast. Bulls rightly pointed out that on average bull markets last a lot longer than what we had seen to this point. But then we have a big storyline that really rattles investors, and so they've been at the very least repositioning. So let me just go back to: do you think a stock bull market is still intact despite the recent uncertainty?
Yeah, I do. I think this year is going to be choppy. Our theme coming into this year was bring an umbrella, and simply because we're expecting some type of volatility to show up because, like you said, the last couple of years have been fantastic years in the market, and typically we have these types of corrections regardless of the events that are happening. The average correction is 10% in the U.S. stock market. So we've been expecting this. So, we've positioned our portfolios to do that. But I think at the end of the day, the market needs to have a breather. It needs to understand how these tariffs are going to impact the companies. And so rightfully so, we are seeing this correction in the U.S. stock market. So going forward, I think the bull market is intact, but I think we're just going to see more volatility this year than we have in the recent years.
Okay. Well, against that backdrop, let's talk about some different examples, because I guess there's two ways to go. Either you can be worried about where we're going, but I always like how Warren Buffett would put it. People really get concerned when stocks are down, but they get excited when prices are down at the store. So if you are a shopper in the stock market, Bloomberg's headline on Amazon in the last couple of days caught my attention that based on valuation, the shares are cheaper than Apple and Walmart. Now, Amazon is a stock that you like. What goes into that analysis?
Well, historically, over the last decade, the valuation has been around that 50 to 60 times next year's earnings. Price to cash flows have been up in the high 30s. And so right now you're getting Amazon at a 30 times next year's earnings multiple. So, from a historical valuation standpoint, it's cheap. But when you also think about the AI aspect of Amazon and their AWS platform, they don't get a lot of credit for the AI. People are more focused on the consumer end of Amazon and the packages and ordering and everything like that. So I think at the end of the day, when you look at Amazon and strip out how fantastic their AWS platform is and the AI models, the large language models that they're building underneath that and offering that to their customers, I think that's going to drive Amazon stock going forward.
Okay, and let's stay with the tech theme. Actually, let's stay with the Magnificent Seven. I'd have to check the numbers on this, but I'm pretty sure Meta is the only Mag 7 stock that remains in positive territory for the year, in part because 2025 starts and those shares were ripping. Now, I guess the flip side is stock got up to like $735 or something like that, and it has pulled back. But if you like Meta, I assume that AI theme you just talked about factors into Meta too?
Exactly. And from a Meta standpoint, it's 21 times next year's earnings, which is quite cheap when you consider their growth relative to the S&P 500. That's trading at 20 times. And also, when investors are looking at the AI play or how much these companies are spending, the hyperscalers are spending $300 billion this year. And Meta is really the first to start monetizing their AI platform with their ads business. And so the fact that they're able to do that ahead of everybody else, and investors are looking for that return on investment right now because of that significant CapEx spend, that's why we think Meta shares have really held up versus the rest. And I do think they're the leader in AI in monetization and return on investment going forward from here, which is why we like the name at this point.
Okay, and just a final example of how you're thinking about investing in stocks right now. This is a company I'm less familiar with. APH is the symbol. Amphenol, I believe?
Yep. Yeah, it's you know, it's not the flashy tech play that the Magnificent Seven is. They're just general connectors. And so when you think about the data centers that are working on all of this AI product, these are the guys that are connecting all of that with their products. And it's not as sexy, but you're getting a stock at a cheaper valuation. Again, that's kind of the theme of this, is AI and cheaper valuations. But at the end of the day, these companies are spending that $300 billion. The hyperscalers are doing that $300 billion. And these are the guys that are going to benefit from that. And we saw that in their recent first quarter back in January. We saw a 17% quarter over quarter growth on their AI platform. And we're expecting about a 10 to 15% quarter over quarter growth again for this quarter. So this company is well versed in the AI space, and I think they're going to continue to benefit as these hyperscalers continue to spend the $300+ billion on CapEx.
Okay, Tyler, always appreciate the conversations. Thanks very much for giving us some time today.
Thanks.